Okay, so there's something uh, really significant happening right now in the U.S. natural gas world.
Hmm.
And it's maybe not what you'd first think of. It's LNG exports, liquefied natural gas.
Yeah, it's been ramping up quite a bit.
Exactly. So for this deep dive, we really want to cut through the noise, understand this, surge in US LNG heading overseas.
Figure out what's behind it.
Right. What's driving it, who's affected, and why it's actually important for you to, well, get a handle on it.
And to do that, we've got the oil and gas trends report right here. So this isn't just guesswork.
No, it's based on, solid industry analysis, gives us a pretty clear picture of how things are shifting.
Right.
So we're going to look at the rapid growth in export capacity, zoom in on key areas like the Haynesville Basin, trace the ripple effects on prices, markets, and also touch on the policy side of things, which is always changing.
Always. Okay, let's jump in.
Huh.
So the big picture first, it seems pretty clear the U.S. is, well, really moving into the driver's seat here.
Yeah, we heard recently from US Energy Secretary Chris Wright talking about continued growth in LNG supplies going to Europe.
Right, and that's happening because Europe is, very actively trying to reduce its reliance on Russian gas.
Definitely. They're signing these new long-term deals, and that's a huge pull for U.S. exports heading that way.
But then there's this other really interesting twist, China.
Ah, yeah, the trade tensions.
Exactly. They just, boom, suspended all U.S. LNG imports. Very sudden.
Wow, all of them. That's a big deal. That creates a real headache for U.S. producers, doesn't it?
It does, especially when they're bringing all this new capacity online.
Yeah.
Suddenly, a major potential market is just gone. They need new buyers fast.
Okay, so let's talk about that capacity. Just how big is this expansion?
The numbers are pretty staggering, actually. The EIA, the Energy Information Administration, they're projecting a 19% jump in gross LNG exports this year, 2025.
19%.
Yeah, hitting about 14.2 billion cubic feet per day. BCFD, that's a lot of gas.
And that's just this year.
And then another 15% increase forecasted for 2026. That takes it up to 16.4 BCFD.
Incredible numbers. So where's all this new capacity coming from? It has to be new facilities, right?
Absolutely. It's driven by several major new LNG export terminals coming online. You've got Plaquemines LNG, both Phase 1 and 2.
Okay.
Corpus Christi LNG Stage 3, and Golden Pass LNG.
Right.
Put them all together, once they're fully up and running, they'll boost total U.S. LNG export capacity by nearly 50%.
50%. Wow. That's like adding half our current ability to export in just a few years.
Pretty much.
So when are these actually starting up? Is this happening now?
It is. Plaquemines LNG Phase 1 actually started shipping its first cargoes back in December 2024.
Okay, so it's already started.
Yeah, and it's expected to be fully ramped up by, well, about now, April 2025.
Right.
Corpus Christi Stage 3 sent out its first cargo just last month, February 25.
Okay.
And Venture Global, they run Plaquemines. They're aiming to bring Phase 2 online by September this year.
So this isn't some distant future thing. It's happening right now, adding capacity month by month.
Exactly. The build-out is actively unfolding.
Okay, so huge export capacity increase. Let's pivot to a specific region that's key to all this, the Haynesville Basin.
Ah, yes. The Haynesville.
Why is it so central to these LNG plans?
Well, location is a huge factor. The Haynesville Shale, it stretches across East Texas and Northwest Louisiana, which puts it strategically really close to all those Gulf Coast LNG terminals we just talked about.
Right, shorter pipelines, cheaper transport.
Yeah.
Makes sense.
Exactly. Less distance, more efficient. But it's not just location.
Oh, else?
The gas itself, the natural gas from the Haynesville, it tends to have fewer impurities.
Okay.
Which makes it, kind of ideal for the liquefaction process, easier and cheaper to turn into LNG.
Interesting. So location and quality. Now, the report mentioned policy changes impacting the Haynesville too.
That's right. There were some restrictions on new LNG projects, and easing those has definitely sparked renewed interest and, frankly, investment in the Haynesville.
So what are producers doing?
They're responding. We're seeing increased drilling activity there. People are talking about expansions again, trying to position themselves to meet this expected wave of LNG-driven demand.
Okay, so more drilling in Haynesville, more gas flowing to these massive new export terminals. That has to be affecting the domestic market, right? Prices, storage?
Yeah, absolutely. We're definitely seeing the impact domestically. U.S. natural gas prices, they've risen this year, 2025.
How much?
Well, the Henry Hub futures price, which is the main U.S. benchmark,
Right.
It averaged $3.74 per MMBtu, that's million British thermal units, the standard heat measure in the third quarter.
Okay, $3.74. How does that compare?
That's up 17% compared to the same time last year, so a pretty significant jump.
17%. Wow. And isn't that happening even though I thought I read domestic gas production is slightly down and the rig count too?
That's the interesting part. Yes, production is a bit lower. The gas rig count has dipped, factors that you'd normally think would push prices down.
So why are they up? Is it just the export pull?
That's a big part of it, but another key factor is storage. Natural gas inventories, as of April 2025, were actually running about 4% below the 5-year average.
So tighter supplies domestically.
Exactly. So even with slightly less drilling, the combination of strong export demand and lower than average storage levels is keeping prices firm. It shows resilience.
Okay, that makes sense. So domestic factors matter, but obviously LNG is a global commodity. How much do things like European or Asian prices or, geopolitics influence where all this US LNG actually goes?
Hugely important. At the end of the day, prices in Europe and Asia, plus whatever geopolitical events are unfolding, those are the main things determining the destination for U.S. cargoes.
And right now, Europe's the main destination.
Primarily, yes, given their push away from Russia. But, and this is important, U.S. exporters are definitely looking more and more towards Asia.
Seeing that shift already.
We are. You see it in new sales agreements being signed, shifts in where ships are actually heading. Asia's a huge long-term market.
Now, the report also mentioned something about the oil market taking a big hit recently. How does that fit in?
Yeah, that was quite dramatic. April 2025 saw a really sharp oil market sell-off. Brent crude, the international benchmark, fell down towards $63 a barrel. That was the biggest monthly drop since, I think, 1988.
Wow. What caused that?
A couple of things, really. One was growing concern that the U.S.-led trade disputes were hitting global economic growth.
Right, slowing demand for energy.
Exactly. And at the same time, OPEC plus the group of oil-producing nations decided to loosen their production cuts, adding more supply to the market.
So less demand, more supply. Prices fall.
Pretty much. And analysts were warning, prices could fall even further if OPEC Plus ramps up production more.
So kind of a gloomy picture for oil prices then.
Yeah.
But wasn't there some surprisingly good news for U.S. oil companies in the report? Something about interest expenses.
Yes. That was quite interesting. Despite, interest rates generally going up since 2022, U.S. oil companies have actually managed to lower their real net interest costs per barrel.
How does that work? Seems counterintuitive.
It does, but it's a mix of things. One, they've gotten much more efficient at drilling. Better technology, better techniques mean they get more oil and gas out for less cost.
Okay, efficiency gains.
Two, higher oil prices over the last couple of years boosted their revenues, giving them more cash flow.
Right.
And three, many companies have actively worked to reduce their overall debt levels, so they just owe less money.
Okay, so less debt overall.
Exactly. So the EIA looked at data for 26 public companies in 2024. Their average interest expense was only about $1.50 per barrel of oil equivalent.
That doesn't sound like much.
It's not. It's only like 6% of their production expenses. And crucially, it's actually lower than it was before the pandemic, even though the main federal interest rate is higher now.
So they're managing their finances well, despite the broader rate environment.
You could say that. Improved efficiency and healthier balance sheets are making a difference.
Got it. Okay, let's bring it back to LNG policy. You mentioned earlier that the government's approach is changing.
Yes, there was a significant policy reversal recently. The administration undid a previous rule.
The Biden-era one.
That's the one. It required LNG projects to start exporting within 7 years of getting their approval.
And now?
Now they've gone back to the older system, which is more flexible. Projects can apply for extensions on a case-by-case basis if they face delays.
And the industry likes this change.
Generally, yes. It's seen as positive because building these huge LNG facilities takes massive investment and time. This flexibility provides more certainty for those long-term commitments. It should help streamline development.
Okay, so if we try to wrap all this up, what's the big picture takeaway here?
I think the main point is that this U.S. LNG export boom is fundamentally reshaping the natural gas landscape, not just here, but globally.
It's a huge new source of demand.
Exactly. It's influencing prices, it's changing trade flows, it's even impacting, international relations and energy security discussions.
And for people working in the industry, especially the upstream side, drilling and producing the gas, The report stressed being adaptable,
Absolutely. For upstream folks, this environment really demands agility.
meaning.
Meaning being ready to adjust drilling plans quickly as market signals change, continuing to invest in tech to improve efficiency and keep costs down, and keeping a really close eye on policy shifts, like the one we just discussed, to make sure they can navigate and, well, capitalize on this evolving landscape.
So summing it all up, the U.S. is quickly becoming, maybe already is, a dominant player in global LNG.
No question.
And that has really far-reaching consequences for energy markets, obviously, but also geopolitics, even regional economies right here in the U.S. near the production areas and the export terminals.
It touches a lot of things, which leads to, a final thought for you, the listener, to chew on. Given all these massive shifts, the export boom, the changing trade patterns, the policy adjustments, what are some of the maybe unexpected second-order effects we might see down the line?
Like in related industries or international relations.
Exactly. What new questions does this raise about, say, long-term global energy security or the future of international trade alliances? It's definitely something that warrants further thought.